Hey guys, welcome back to the channel. In this video, I'll be analyzing a stock that you guys recommended in the last video, STOR Capital, ticker symbol STOR. I'll be going over their business model, their tenants, and their future outlook, and I'll also draw comparisons to two REITs that I hold in very high regard, Realty Income Corp and WP Carey, to see how they stack up. At the end of the video, I'll be giving STOR Capital a rating from 1 to 10 from the perspective of a dividend-focused investor, so make sure you stick around to the end of the video to see that. Before we jump into the analysis, guys, just know that I'm not a financial advisor. Anything I say in this video is just from my experience and research into the company, and you should always do your own research before making any investment decision. If you guys are unfamiliar with STOR Capital, they're a REIT, or a real estate investment trust. The significance of this title to investors is the way that they pay out dividends. Now, I won't be diving into all the details in this video, and I've touched briefly on some in the past, but if you guys are interested, I could dedicate a future video to explaining the intricacies of real estate investment trusts. But STOR Capital is actually an acronym that does a pretty good job summarizing what the company does. STOR stands for Single Tenant Operational Real Estate. The company acts as the landlord for a variety of single-tenant buildings, and they specialize in net leases, which essentially means that the tenant, or the business renting the building, is responsible for paying any additional costs for the building in addition to their monthly rent. One of the most important factors for a REIT like STOR Capital is the quality and strength of their lease agreements, because strong tenants lead to strong, stable cash flow, which leads to steady and consistent dividend payments. As of the end of the first quarter in 2020, STOR Capital had 2,552 properties leased out to 491 individual customers. And on the screen now, you can see their top 10 customers. At the top of their list is Fleet Farm, which is a company that sells items for outdoor living, from hunting gear to lawn and garden supplies. Then we have Art Van, a furniture retailer who recently filed for bankruptcy, Bass Pro Shops, which includes both the Bass Pro Shops stores and Cabela's. When looking at this list, two things pop out to me. One of them is a positive and one of them is a negative, but let's start with the positive factor. If you look at the column right next to the logo, the percentage base rent and interest, this shows how much of their total business relies on each individual customer. And these numbers are very low for STOR Capital. Even their largest customer, Fleet Farm, is less than 3% of their income. And this is a positive because it limits the risk associated with each tenant. For example, if you're a real estate company and 50% of your rent is coming from one company, what happens if that company stops making their payments? What happens if they declare bankruptcy? Or what happens if at the end of their lease agreement, they decide to move their operations to another building? Your monthly revenue will be cut in half, and your business will lose money because you need to continue paying the mortgage on that property even if you're not collecting rent. So, when a company like STOR Capital doesn't rely on one customer or a couple large customers for a huge part of their rent, investing in the company becomes much less risky. However, the negative factor that sticks out to me on this list is the future outlook of some of these companies. I mentioned about a minute ago that their second largest tenant, Art Van, has already declared bankruptcy. And another company on this list, Ashley Furniture Home Stores, is pretty similar to Art Van in their business model, so the outlook for Ashley could also be weak. Also, Cadence Education and the Spring Education Group could be severely impacted by the current pandemic that we're experiencing. Now, I'm not confident in saying that it will have a negative impact on these education companies, but the outlook right now is much less certain than they were a year ago. Also, AMC Theaters is a fairly risky tenant. Not only has theater attendance struggled in the last couple years, but with the current pandemic, many theaters are shut down, and some movie distributors are not releasing big movies in theaters and are going direct to consumer on their streaming platform. In general, their top 10 customers are not need-based businesses, and the outlook is a little scary for a few that I just mentioned. So that's definitely a negative factor to consider. Overall, I would say that despite the very low tenant concentration, STOR Capital's tenant base is much riskier than WP Carey's, and the gap widens even more when you compare it to the tenant base of Realty Income Corp. In the company's investor relations presentation, which, by the way, is my easiest way to get a good idea of the company from a high level, they report that 75% of their contracts are investment grade. And at first glance, I was taken aback, because only around 50% of Realty Income Corp's tenants were investment grade. But the language that STOR Capital uses can be confusing unless you look into the details a little bit. In the appendix to their presentation, all the way at the back, they show the graph on screen. And this gives a much better picture of the tenant quality versus their contract quality. In essence, the graph shows that over the last 2 years, their tenant quality has dropped a little bit, but the company has made up for this by signing more favorable contracts with these tenants. For example, at the end of the first quarter of 2018, around 18% of their tenants would be considered investment grade, and this percentage dropped to around 14% as of the end of the first quarter of 2020. However, STOR Capital maintained the percentage of their contracts that are rated investment grade to about 71 to 72%. This shows that the management is aware of their declining tenant quality in their businesses and are taking steps to mitigate the additional risk by making the structure of the contracts more favorable towards the lessor. So to sum up my thoughts on their tenant base, I'm really not impressed. STOR Capital's tenant quality is already a little lower than I would like, and it's continued to worsen over the last 2 years. I really do appreciate how the company has diversified its tenants. It's not nearly enough to cover the additional risk that comes with less stable tenants. Now, an investment in STOR Capital also has its positives. For example, let's look at their growth over the last couple years, which you can see on screen now. Since 2015, STOR Capital has grown its net income per share by an average of 16% per year, which is a very respectable growth rate. And although I don't have statistics to back this up, I'm pretty confident that this puts them at the top quartile of companies in their industry of the same size. During this time, they've grown their AFFO, or their adjusted funds from operations, by an average of 7.5% per year. This number represents the amount of cash flow a company receives from its operations after capital improvements, like building renovations for example, are deducted from their cash flow. And where this really impacts investors is in its dividend growth rate, which has averaged 7% over the last 5 years. This growth rate has allowed the company to get to a point where the current payout ratio is 5.7%, which is a very, very attractive yield. However, a large part of the growth in their dividend yield is the recent drop in their share price. Their stock price has been impacted heavily by the COVID situation, and with the rest of the stock market close to fully recovered, this stock is still down 40% from the highs that they reached in February. So, there could be an argument that the stock is very undervalued right now. But, to summarize my thoughts on this stock as an investment at current prices, I personally am not a fan. For sure there are positives about the stock, including their low tenant concentration, their recent growth history, attractive dividend yield, and the low stock price. However, there's a lot of risk with this company. From what I can tell, the growth that the company has seen has been at the expense of their tenant quality. This has led to very attractive profits in the short term, but I don't think it sets them up for long-term success. When I look at the alternatives like WP Carey and Realty Income Corp, both of which I own and have made videos on recently, there's too much risk associated with an investment in STOR Capital that I don't see reflected in future potential gains in investment when compared to WP Carey or Realty Income Corp. As I've mentioned in the past, the dividend yield on a stock only matters as long as it's sustainable, and the dividends of WP Carey and especially Realty Income Corp are much more safe than the dividends of STOR Capital. For all of those reasons, on a scale of 1 to 10, I would rate STOR Capital a 4 right now. They're not a terrible company, and I could see some investors using them as a speculative real estate play. But I think there's just better options out there that I would rather invest my money in. This video is thanks to one of my subscribers recommending that I analyze the stock. So if you have any stocks that you would like analyzed, make sure to comment them down below. Also, if you enjoyed the video, make sure to hit the like button and subscribe so you don't miss the next episode. Popping up on the screen in a second is a playlist of all the analyses that I've done on REITs. Also, make sure to click on one of those, and I will see you guys in the next video.